All right, we need to talk about what's been happening in the crypto market. The last 41 days, honestly, they've been one of the strangest, most dramatic periods we've seen in a long, long time. So, let's get into it and figure out what is really going on.
So get this. In just 41 days, the crypto market has wiped out an incredible $1.1 trillion in value. I mean, that's like $27 billion vanishing every single day. The scale is it's hard to even wrap your head around.
And that, of course, leads to the big question. Why? What on earth is causing this massive, relentless sell-off? Well, I'll tell you this. The answer's probably not what you're thinking. Okay, so here's where it gets really weird. This whole thing is a paradox. It's a mystery. Because if you look at the fundamentals, nothing has actually gone wrong. You know, there wasn't some huge hack, no major protocol imploded. In fact, we've had some pretty positive news, the kind of news that you'd think would send prices soaring.
And yet, this is the reality. Despite all that, Bitcoin has plunged a full 25% in just the last month. The chart doesn't lie, and it's pointing to a really serious problem under the hood.
And to really hammer home how strange this is, think about this. Just a few days ago, President Trump was out there saying that America leading in crypto is a top national priority. You'd expect a statement like that to be a huge boost for the market, right? Not the prelude to another slide.
So, this is the key takeaway. The drop we're seeing isn't about some bad headline. It's not even really about what's happening in the broader economy. This is a structural, almost mechanical problem baked into the crypto market itself, and we're going to break down exactly what that means. So let's play detective for a minute and follow the money. Because the first clue, the thing that really kicked this whole avalanche off, started back in mid to late October. And it began with huge amounts of institutional money heading for the exits.
And here it is. This chart shows us that first big clue. It tracks the weekly flow of money from big institutions. And just look at that spike in outflows right there in weeks 44 and 45. We are talking about a massive amount of cash leaving the market in a blink of an eye. To put a number on it, the outflow in just the first week of November was $1.2 billion. The smart money, the big money, it started running.
But here's the thing. That institutional selling, that was just the first domino. It was a relatively small push that, because of how this market is built, was about to topple the entire system. And the reason comes down to one simple, dangerous word: leverage.
Now, for anyone who's not familiar, leverage is basically just trading with borrowed money. It's kind of the signature of a young, Wild West market where there aren't many regulations and the appetite for risk is just off the charts. It lets you make absolutely massive bets, but it also means your losses get amplified like crazy if the market even hiccups.
And this table just lays it all out there. It shows you how unbelievably reckless crypto leverage can get. We're not talking about 2x leverage here. People are using 50x, even 100x leverage. And at 100x, a tiny 1% price drop is all it takes to completely wipe you out. Your position gets liquidated, it's just gone. So, here's the recipe for the crash. That initial push from institutions selling causes a small price dip, but that dip is enough to trigger liquidations for all those 100x traders. That forces more selling, which pushes the price down even further, which then triggers the 50x traders to get liquidated, forcing even more selling. You see, it's a vicious, self-fueling domino effect. And this is the result. It's pure carnage. Each one of these spikes represents hundreds of millions, sometimes billions of dollars in traders' positions just being vaporized in a single day. Think about that, over $1 billion in forced selling. That's happened 3 times in the last 16 days. This isn't people deciding to sell. This is a machine, an algorithm forcing them to sell, and it's what's dragging the entire market down with it. So let's talk about the aftermath of all this. Because this kind of mechanical, relentless selling, it has a huge psychological impact. It completely crushes market sentiment and leaves you with a market that is just gripped by pure, unadulterated fear. And we can actually put a number on that fear. The Crypto Fear and Greed Index, which goes from 0 to 100, recently hit a 10. That is literally the definition of extreme fear. Nobody wants to buy, nobody wants to step in when it feels like the floor could fall out from under you at any second. And in an environment like this, we start to see some really strange things. For over a year, Bitcoin and gold were kind of moving together, both seen as safe haven assets. But since this crash kicked off, they have completely decoupled. Gold has actually outperformed Bitcoin by 25 percentage points. And you know, as bad as things look for Bitcoin,
It's actually even worse for the rest of the crypto market. Ethereum, for example, is down 35% since early October. That's not just a correction, folks. That is a full-blown bear market, and it's happening while other risk assets, like tech stocks, have been rallying.
So, when you see this kind of mechanical unwinding, this level of extreme fear, you have to ask a really big question. Is this a fatal flaw in how the market is designed? Are we looking at a funeral here? Or is this just a really, really painful growing pain?
Well, the perspective from the source material is that, yeah, this downturn absolutely hurts, but it's likely a growing pain. The idea is that just like any other market that's maturing, these kinds of structural problems, like all this crazy leverage, they'll eventually get ironed out as bigger, more sophisticated money comes into the space.
And there's a huge macro reason to be optimistic. The global M2 money supply, that's a broad measure of all the cash in the system, has hit a record $137 trillion. Now, when there's that much money sloshing around the global economy, it has to go somewhere. And a lot of it tends to flow into assets like stocks, real estate, and yes, historically crypto.
And there's even more on the way. Japan is getting a $110 billion stimulus package ready. Here in the US, they're talking about tariff dividends. All this liquidity is basically fuel. And if you look at history, crypto has responded incredibly well to these huge waves of new money flooding the system.
Which really leaves us with the ultimate question. Is the 4-year cycle over? On one hand, you have a market with a broken, leverage-driven structure. On the other, you have this historic tidal wave of global liquidity. How that conflict resolves itself, well, that's what's going to define the next chapter for crypto.